I'm delighted to welcome our speaker, Tae Hea Nahm. Tae Hea is the co-founding managing director of Storm Ventures, a VC firm investing in tech and SaaS startups. He's also the co-author of the book series Survival to Thrival, Building the Enterprise Startup. His second book, Change or Be Change, was released in July 2019 and addresses the silent worries of many tech entrepreneurs, such as, can my company outgrow me? The first book is called The Company Journey and introduces the concept of the term go-to-market fit, the key to unlocking growth. The aim of this book is to demystify building enterprise startups and leaders. He provides entrepreneurs such as yourselves a four-step path to unlocking growth, anticipate what happens next, and let them know that you're not alone, that you have allies on this journey. At Storm Ventures, Tae Hea was founding CEO and investor in aerospace, which was later sold to Cisco for $450 million. So what a terrific track record of taking company, to a great exit. As an applied math major and an early career as an attorney, he brings a unique perspective to entrepreneurship and startup and how to accelerate your success. So with that, I'm going to turn it over to you, Tae Hea. Take it away.
Great. Well, thank you very much for the kind introduction. And as I go through the talk, please feel free to ask questions because, questions is how I get better. And so this is actually a new version of the presentation to reflect the new content that we just started releasing. And I'd like to really position it as advice to first-time CEOs. In terms of background, I think, you had a great background, so I'll skip over that. But just want to emphasize that we do have the new version is going to be free and is on unlock.survivaltothrival.com. So I want to focus on two questions for today, and it was referred to in the intro as well, is how to unlock growth. And that's about finding go-to-market fit, and also why many CEOs fail, and that's because they don't have a good systems model. And I'll point out how the two are actually interconnected here. The reason why go-to-market fit is so important is that this is sort of the landscape of today's financial markets right now. On one hand, there's a tremendous worldwide cash glut of trillions of dollars looking to invest in high yield, which is high growth. On the other hand, there's a worldwide startup boom created by governments all around the world to replicate Silicon Valley, whether it's in Europe, whether it's in Korea or in other places. And all these startups want cash. And it's almost like right now the two worlds are separated by this giant wall until you find go-to-market fit, you unlock growth, and then all of a sudden these two worlds mix very well. And so what go-to-market fit does is that it gives you that repeatable growth that allows you to be scalable and predictable, which investors love. And so as a result, it unlocks growth and then capital. Now, for people that haven't been in a high growth company, it's always good to sort of ask, what does go-to-market fit really feel like? And the best example is really this photo is you have one person who's caught the wave and feels momentum and starts surfing, and the other three that are so close, they can taste it, they can smell it, but they haven't caught the wave, and as a result in a highly frustrated mode. So we see this a lot. Fortunately, many of our companies have caught the wave and got momentum, but being on the other side, being so close and not having it is also a very frustrating experience here. So how do you find go-to-market fit? And what we outline in our new websites, unlock.survivalthrival.com, is a four-step path. And going back to surfing, it has sort of the four steps of you got to catch the wave, have the right surfboard, ride the wave, and you want to improve the ride with data or metrics. In the same way, the first thing you want to do is you want to nail the customer journey, and what that gives you is momentum. The second about the right surfboard is building this repeatable go-to-market playbook, and that'll give you repeatability. Riding the wave is operationalizing the playbook so you know who does what, who takes what lead, and that allows you to scale. And then lastly, it's about using metrics to iterate the playbook to drive execution. So let's talk about catching the wave. The key to catching the wave is to look at it from the customer's perspective and not from the company's perspective. And what we found is that it's best exemplified in this risk asymmetry view between the customer and the founders. From a customer standpoint, and this is a direct quote from a customer, is that in vendor selection, there's more downside risk than upside. In other words, if the customer picks the wrong vendor, then his colleagues and employees may be talking about it for months or years about how this, IT person chose the wrong vendor. So they see a lot of downside risk. From the founder perspective, though, it's all about upside. It's about why this is going to just revolutionize the company, the industry, and why the strategic vision is so overwhelming. And so what we see is that there's this risk asymmetry between customers and founders. And companies that catch the wave are able to basically break this risk asymmetry. And they do it in three ways. The first is they address an urgent pain. So customers can't wait. They have to make a decision right now. And that's a way of sort of starting the customer journey with the urgent pain. And then you want to end the customer journey by showing how your product will be strategic so your customer and more importantly, your champion has upside as well too. And then lastly, connecting the two from the urgent pain to becoming strategic is something that you can do with thought leadership. And so I mentioned the beginning and the end of the customer journey, but there are some important steps within the customer journey as well too. And those are knowing your wow. The wow is something that causes your buyer to become a champion. You can sort of see it. It could be a demo, it could be a report, it could be something, but it causes the potential customers to move to the next stage of the customer journey. They cause them to take a specific action like invite a colleague, they want to try it, bring a boss, and ultimately it's determined by the customer, not the product team, the CEO, or the board. And then there's when the customer gets first value, and that's the first time the customer gets real value from the product. And when it occurs, that dramatically impacts your go-to-market strategy. If you can do it early, then you can do product-led growth. If you do it after you sign the contract, then clearly it will be not product-led. Then you have full deployment when the product is fully expanded within the customer. And that's when, from your champion standpoint, the champion's decision is then validated by the entire organization. So the champion is really starting to get recognized by his peers. And then as the company starts adopting new use cases and upsells, your champion then gets recognized by others. And then lastly, becoming strategic means your champion gets promoted, your champion becomes a hero. So this is really the customer journey, looking at it from the customer standpoint rather than, let's say, the sales or marketing stages of a company. What then they translate to is sort of these steps of awareness of the urgent interest, engagement, eval, decide, close, get live, get embedded in workflow, renew, and expand. And as I mentioned, it's all about the customer's perspective. The other two things that's important here is that everyone in the company, sales, marketing, customer success, engineering, product teams must agree on the same customer journey for the customer. You need to do that so that you can build a consistent go-to-market data model for getting all the go-to-market metrics. Failure to do that will just result in just having the wrong metric calculations. It sounds really simple, but it turns out to be the most fundamental thing here as well, is to just make sure you're using the same customer journey for your analysis. And then once you have this customer journey, the next thing about coming up with the go-to-market playbook is basically is what advances customers in the journey. For each stage of the playbook, which corresponds to each stage of the customer journey. It's about what sales and marketing need to say and do, what the wows and blockers are, what tools and delivers, and how the rest of the company can support the company in the journey. But it's really about moving the customer from an urgent pain, which then causes them to be aware of the vendor, all the way to the vendor becoming strategic and helping the customer get promoted. So now what I want to do, because I know I've been a lot of talking and sort of going through a lot of dense material here, is let's apply it. And so we'll apply it through a couple of workshops here. So this is the first one, and want to talk about is an example of one of our companies where we went in and analyzed their go-to-market playbook. So the first thing that you'll notice here is it's on one page. And what we try to do was to show their entire playbook on one page. And I start with, they call it lead generation, which is awareness and interest. It drives to a discovery call where they start engagement. And then they have opportunities where they engage and do evals, and then ultimately tying into a win where the customer decides and closes. So this is a simple playbook that they have, 4 stages. And there were 2 things that were sort of unusual about this playbook as we were analyzing it. The first is on the eval and engage. There was very low conversion from discovery call to opportunity. So that was the first. But then once it became an opportunity, these deals closed very fast. So for sales days, there were very few, and then it closed quickly. So with that, the question became, well, what was there something missing? What is happening in this playbook? And I don't know if I'm able to get answers here, but I just want to pause and see if people have any suggestions on what the reasons might be.
Okay, unmute yourselves and just say your name and state your company before you respond.
Hi, Tae Hea. This is Vikram Sharma at Quintessence
Yes.
Labs in Australia. Just going back to your previous slide, I guess low conversion rate, would it have a potential cause in a understanding of the market fit or customer needs and not understanding those well enough, thereby not being able to resonate? Or a second perhaps thought which ties into what you said in the opening is not having an internal champion who early enough will be willing to support you through that purchase journey.
Right. No, that makes a lot of sense. That, I mean, obviously, you've got to get the right champion to sort of drive through it. I unfortunately hit the advance button too quickly. What this company did is they were just skimming fast deals. So in other words, they would go from the discovery call and immediately from that figure out which deals they believe would close fast and just focus on those. So they were skimming these fast deals, and that's why they had a low conversion rate from discovery call to opportunity, while at the same time they had a very fast sales cycle. So from opportunity to close, they went very quickly. So they were doing this as skimming fast deals. And what that means as well is that they were dropping all these slow deals. And what the company then did as a result is they added a new stage in their playbook, basically nurturing. And so as a result of that, then they would then cause them to sort of nurture these slow deals as well too. There was a question about who would take the lead, marketing or sales, but it's a way of then adding this sort of new stage into their funnel as well. So the diagnosis of this particular problem is that sales was just skimming fast deals. They added this stage, but then another key part of the action plan is that to make sure that sales wouldn't just focus on skimming deals, what they did is that they had the sales reps focus on two metrics. One is obviously closing new deals, but the second is to create new pipeline. So to create opportunities. So by having these two, they would now have about creating opportunities and then closing deals. And so as a result, they had a more complete playbook and their overall conversion was doing much better. So in the website, we provide other examples of playbooks, whether it's product-led like SendGrid, marketing-led by Marketo, and sales-led by Mobile Iron. So it's in the website. We're going to provide more opportunities there. The third stage of the playbook of finding go-to-market fit, once you have the right playbook, is basically how to operationalize it. In other words, it's for each stage, basically who leads it, who does what. And as you can see at the top, this is where at different stages, we have marketing and would lead it. We had sales leading at different stages, customer success and sales. Or in the one below, you can see we had marketing, then product, customer success, and the product team. And so depending on who leads what stage, it can then determine your go-to-market model, where the top one is sales-led, the bottom one is product-led. In either one of these cases, a key point is this handoff between marketing to sales or marketing to product or sales to customer success. And so understanding and navigating this handoff is important. And so with that, we'll go to the second workshop here. These workshops are sort of new, so I'm just sort of trying it out for the first time as we're doing this. And this has to do with the marketing and sales handoff. So on the left-hand side is the typical, like I just took this out of one of the companies. It's a typical marketing board report, a lot of metrics, showing demo per meeting, request per meeting, qualified meetings by source, opportunities by source, meeting to stage one, opportunity conversion. And usually we get like this page, next page, multiple pages of marketing metrics about all the things that marketing is working on. What I like to focus on in the workshop is when you think about, instead of these marketing metrics, but instead a marketing to sales handoff, at the high level, what would be the top metrics people would care about in terms of the handoff from marketing to sales? Well, I'll go ahead then. So from my perspective as a board member, when I look at marketing and sales, the key handoff I look at is these two things. The first is, how much new pipeline was created by marketing? So it answers the question, do we have enough pipe to make next quarter? But how much new pipe is created by marketing? And the second is marketing making the materials to help sales close the pipeline, whether it's sales collateral, website, reviews, all these other things to sort of help sales convert. But the first question really is on this new pipeline created. And I see that as the handoff. I just got a comment here. I'm sorry. It goes, I think the main metric for marketing to sales is the number of marketing qualified leads that align with the ideal customer profile, qualified pipeline. That's close. My concern with that definition is that when you talk to the salesperson and says, I'm giving you MQLs, salespeople say, I don't care. I want pipe. And so if you're marketing qualified leads is a great marketing term. And I was on the board of Marketo for 10 years. And, Marketo helped create the term marketing qualified lead. But that term doesn't convey this like passing the baton to sales. Sales would not pick up an MQL. And so that's why I like to think about it as it's pipeline created. And obviously it has to go to fit the ideal qualified customer profile, and others. But within this new pipeline created by marketing, there are 3 sub-metrics I look at. And they are the quantity, quality, and efficiency. Quantity is simply new pipeline created per sales rep, because you want to create at least 3x of their quota. The second is quality, and that's measuring the new pipeline conversion by cohort, and I'll give exactly what that is. And the third is efficiency, which is new pipeline created for dollars spent on marketing.
I can pause
Yes,
if I can pause for a minute now.
Yes, that'll be great.
I've got a hand raised. Femi Aiki from Foot Locker. You have a question? You've been waiting patiently.
Yeah, thank you very much. Sorry, my video is a bit messed up. Thank you for this. I just wanted to find out, this is actually B2B specific, right?
Yes, it is. Yes.
Okay. The follow-up question to that is, when you say product-led, does that mean there has to be some kind of build or product development that takes place versus a typical sort of sales-led handoff or handover?
I'm sorry, I didn't quite understand could you repeat your question?
So when you said there are 2 kinds of handovers, so there's from the marketing to the sales handover, and then there's the marketing to the product handover. So for the product handover, does that suggest there has to be some kind of build or product development that takes place after sort of the prospecting has been done by marketing?
Well, I meant that more as self-serve. So, marketing makes the customer aware of the product, and then the customer is doing self-serve for product-led growth. Product itself underlines all the go-to-market, whether it's sales-led or product-led. It turns out, in my experience, that 90% of all the major problems in go-to-market are product issues, regardless of whether it's sales, marketing-led, or product-led. But what I wanted to do was to just step back and really on this handoff, because this handoffs between one department to another is where in go-to-market execution we see a lot of problems. And that's usually within each silo, you have relatively good execution. But when it comes to these handoffs, you have each silo is focused on their own particular metrics instead of thinking of it as a baton that needs to get passed from one to the other. I see here from David, it says, we have a term called sales accepted lead, and we monitor MQL to SAL conversion. That's absolutely right. And you need to do that. And that's looking at sort of each stage of the playbook. But MQL to SAL conversion is all sort of within the marketing silo. And as well, I take that back. I mean, sales approved lead is with sales. So, it is related to handoff, and that is a good metric to use. What I'm just trying to do is, sales is going to make their quarter or not. And they always ask a question is, are you generating enough pipeline for sales? And so you look at the quantity, quality, and efficiency. So for quality, what I like is this cohort and analysis, conversion analysis. And so what this shows is, for a company, the conversion of new pipe generated for that quarter. So in other words, this is the first row is new pipe created in Q1 2020, and in the first quarter only 1% converted. In the next quarter up to 4%, 7%, 10% conversion, whereas as you go down you see conversion doing better. So what this is showing is marketing is creating all this new pipeline, what do you call it, sales approved leads, or just call it new pipe. The question, new opportunities. The question is, how is it converting? And this shows if you have good conversion that you have alignment between the pipeline being created by marketing and what sales is converting. If not, you have a disconnect. So now I want to get to the fourth sort of step in finding go-to-market fit, and that's about metrics. And metrics are a bit confusing because there's metrics for everything. And so, metrics about setting goals, measuring, iterating, but I think the key to metrics is going to be about being able to zoom in and out with this sort of systems view. So when we look at metrics, I categorize metrics in this manner: is with a customer journey, that sets your data model for all your metrics. For the go-to-market playbook, for each of the stages, you have stage metrics. Then when you operationalize the playbook is for what each team does. So you create team metrics. And then we have system, and then let's go to the bottom, which is to answer the question, how do you know you found go-to-market fit? Are these end-to-end metrics, or you can say board metrics, or or investor metrics. And in between them are system metrics, which allows you to sort of zoom in and zoom out. The challenge of metrics is that there are just so many metrics that more often than not, what we see is this cacophony of metrics and just confusion as a result. So I'm going to go through and sort of give you a quick review of how I sort of see them fitting together, and then we'll do a workshop about actually applying this methodology. So the first thing I like to do is to create a hierarchy of metrics. So what I mean by that is, you have all the stage metrics which relates to each of the stages, very detailed metrics. Then you have the stages roll up into teams. So then you have team metrics. These teams then roll up into the system. And for a typical B2B SaaS company, it's leads, land, and becoming strategic. Strategic includes expands, upsells, and renewal. And then that all ties into these end-to-end metrics, which answers the question, how do you know you have go-to-market fit? And it's primarily just two metrics: growth, which is net new ARR, and efficiency, which is the magic number. So when we talk about stage metrics, that really allows you to zoom in at each stage, and it's talking about the number in each stage, how many entered each stage, what's the time they spend on the stage, and the conversion going from one stage to the other. A typical representation is on the right-hand side. You see this sort of funnel kind of metrics and all this. It's great. It gets down into the detail as you sort of zoom in and see all this. And as I mentioned, when you zoom out, we have these sort of two key board metrics, which are about growth and efficiency. And from a team standpoint, you can really feel momentum. That's what you feel. So what links these two is you need a systems model to connect this sort of zoom in, zoom out. And not having it, what it does is you have all these, but you can't see how the detailed metrics tie into the board level metrics that people care. And that's where having this like stages of lead, land, and strategic become really helpful. And so let's talk about how we actually apply this now in this workshop. So this is another example of a company I was at just a while ago. And this is like applying the systems kind of model analysis to analyzing net new ARR. So at the board meeting, they reported that they missed their net new ARR. Not a good thing. That means that they're growing slower than planned. And the question then becomes, well, what action do you take? Okay, because we missed our net new ARR number. So can walk through sort of this kind of analysis that you can do applying a systems view. Any particular thoughts on terms of what would be sort of the next step here in the analysis? So what I like to do is, okay, so we've missed net new ARR. The next question is, well, which part of the system are we having problems with? So as I mentioned, there are three parts of the system: land, and then, it's leads, land, and becoming strategic. But here, let's just focus on land and strategic. So on the lands, this is getting new ARR from new customers. They missed their forecast by 50%. So clearly, there's a problem there. In terms of becoming strategic, which is like getting new ARR from existing customers, these are like expands and so forth, or upsells, that beat forecast. In fact, their net dollar retention is 120%. So that's pretty good. And then in terms of renewals, which is also part of strategic, looking at churn and contraction, their gross churn was 1%, which is very good. So clearly, they're doing a very good job with renewals. They're doing a job with upsells and expands, but there was a problem in terms of new lands, basically. And so what we like to do then is say, okay, we know the bottom two are not issues. We then focus on the land, which is new ARR from new customers. So then we sort of then go to the next step of the analysis here. I'm open to suggestions as people go through this, if there are comments or things that people have. So from the systems metrics, what we did is then we focus on the team. And so we looked at sales, marketing, and product, and sort of the key metrics tied to each particular team. So from a sales perspective, we asked, and this goes back to the marketing and sales handoff, did we get enough pipeline? And the answer was yes. They got enough pipeline being handed off from marketing to sales. It was over 3x. And then, do they have enough sales capacity? The question is yes. They had more than enough sales capacity. But, and then the next question was, what's the conversion? And conversion was low. Only 10% of the reps made quota. Only 40% of the reps actually closed deals. So clearly they were having a conversion issue. It wasn't a question of enough pipe, enough capacity, but it was conversion. And then on the marketing side, we go back to the 3 points again of quantity, quality, and efficiency. So from a quantity standpoint, absolutely, we said that they created enough pipe. From a quality standpoint, new pipe conversion went down. It went down from 16% from the prior pipe to 5% on the new pipe. And then efficiency was good. From a product team standpoint, we looked at the win rate, and the win rate was low, 24%. So there was something there that suggested there was an issue as well. So, as I said, we look at this sort of net new ARR miss, looking at the systems metrics, then you get sort of now the team metrics, and then we can then diagnose and then figure out what action. So what happened here is that the new pipeline shifted from addressing use case 1 to use case 2. And the sales team was much less skilled in selling use case 2 than use case 1. So what we needed to do was obviously train sales to sell use case 2 and come out with more sales collateral from marketing and all that to help. And we also needed marketing to go back and also to create more new pipe for use case 1, and then for the product team to make use case 2 and easier to sell, by making it more compelling and so forth. So
a question.
Yes.
Sorry to interrupt. Philip? Are you on mute?
I was. Sorry, it took my computer a moment there. Hi. Thanks, Tae Hea. My name's Philip. I'm from a company called Brazen Therapeutics. And we're in the biotech sector. So I actually posted a question about establishing objective processes, which I think you've kind of answered with your metrics. But it's in relation to when you have an early stage team or a small team where you only have one person or maybe a max of 2 or 3 people performing these sales and marketing functions. And how you can then really set objective measures of these properties when you don't have individual people performing these different functions.
Yeah, I think it's absolutely critical that you start using this process, whether you have just one person or you have thousands. And the key to making it work is making sure you have the right data model in the beginning. And that's why having a good customer journey is the key to all this. If you only have one person, the one person could be addressing all stages of the customer journey. But by having the right data model tied to the data journey, to the customer journey, you can start forming metrics even if you have one person. So you can see where the bottlenecks are and also where you can get scale by adding another person.
And then if you don't mind, a quick follow-up to that is when you're setting that up, how granular do you go with your metrics, especially when you have long sales cycles?
I go as granular as required for the customer journey. Because at the end of the day, it's about getting the customer and making the customer successful. And so that's why I look at it is that you have to start with an urgent pain. Because if you don't have an urgent pain, then the customer has no incentive to make a decision today. So you start the customer journey with an urgent pain, and you end the customer journey with the customer becoming a hero and getting promoted. So that's the beginning and end of the journey. And then you can figure out what are the sort of the key steps along the way in that journey. And so once you have that journey, then that becomes your data model for your go-to-market metrics. And I find it critical to start off with, even if you just have one founder doing all founder-led sales too, if you have thousands of people. But if you have that right data model, it just scales very well. Also, it makes fundraising much easier because you're able to explain it in a very predictable manner, an explainable manner as well.
Thank you.
And feel free to ask me questions along the way. I just don't know how questions are coming, so please just interrupt me. Because as I say, the whole purpose here is to help people sort of just understand, this process that we use.
Tae Hea, this is Vikram here again. You talked about a commonality of the customer experience and journey. Would you care to comment on whether if you're approaching multiple different market verticals, do you see that customer journey across those verticals may have to be adapted and perhaps somewhat different across sectors?
Yes. So basically, each ideal customer profile should have the same customer journey. But if you have multiple ideal customer profiles, they probably have different customer journeys. But to the extent that you can make it similar, it makes it easier for you to scale your sales team and make it easier for your product team.
Yeah, thank you. That's helpful.
Yeah. And in each of these customer journeys I mentioned, it's really about you got to start with an urgent pain. So if there's no urgent pain, it's going to be very hard. And then making it strategic at the end so that your champion does well. And then you have as going back to the key steps in that, which are the wow, first value, and so forth. So those are sort of key milestones in that customer journey. And what I found is that if you don't have those things, then something just breaks down. Like you don't get renewals, or, you don't land in the first place, and so forth. So that's why sort of tying into those steps and looking at it from the customer standpoint. So want to now shift over to the second topic. And I find that why many CEOs fail. And I would say it's usually because they don't have a good systems model. And probably wondering, what is a systems model? Why is this person bringing up systems model, and so forth? We got a little taste of the systems model because that sort of allows you to create these system metrics. As I mentioned in go-to-market, these system metrics is the sort of the connector between all the stage metrics and the board level metrics that the board cares about. So it's sort of something that sort of connects those two. Are the system metrics, and they're created by the systems model, which I just sort of imposed as sort of lead, land, and becoming strategic. But let's talk a bit more about sort of systems model. So, when you look at CEOs, great CEOs have these traits. I mean, they can have a simple strategic plan. They can articulate the strategy, make sure you have the right people in the right roles, can simplify complexity, they make the right decisions, can anticipate problems and opportunities, sort of like a step ahead of all these things. So these are sort of traits of very good CEOs. And what I found is that just like an iceberg, what enables these traits is that if you have a simple system model that connects all the dots, because that is the core that then can manifest themselves in these other ways. So what is a systems model and a system? Oops, let me try to go back here. I haven't figured out how to go back in this presentation. So want to talk about a systems view. And this is actually a quote that came from Ben Horowitz that's in our book, is that perhaps one of the biggest challenges is that the CEO is really the only one person who sees how all the pieces fit together internally and externally. It's not that a CEO is smart or observant. It's simply just having problems. It is a view of the CEO role and the regular interaction across all aspects of the business. I would sometimes take for granted that others could see the systems view in the context I could as CEO. I would jump to conclusions and not share enough of the context and thinking with the team. As CEO, you have to remember that the 360-degree view is unique to you and invest the time to help others see as much of it as you can. So this is really the picture of the parable about, the three blind men and the elephant, or the three blind person. So the VP of sales will see one part of the business, the VP of engineering another, the CFO another part. So each of the team leaders sees their part of the business, and the CEO is unique by seeing the whole elephant. And so seeing the whole elephant is coming up with that systems view. Another example of a systems model is, if you think about the early ocean explorers, Christopher Columbus, Magellan, when people thought the world is flat, having a globe and saying the world is a globe, in a sense, is a system model. And so this is a picture of the oldest surviving terrestrial globe between 1491 and 1493. And in it, they didn't include the Americas, obviously, because, this is around that time. Without a systems model, teams can lose confidence in the CEO, in the mission, and so forth. In fact, this was, Christopher Columbus had a mutiny along his journey. So I look at the systems model sort of like the globe, what the globe was for the early navigators, because as your founder, you're like an explorer going into territory that people haven't seen before. So what is a systems model? The systems model is the simplest high-level framework connecting all the dots. It shows how the different parts of the business sort of fit together. The model helps you understand, predict, and explain the business and the underlying strategy. Building a systems model of the company can help simplify some of the complexity out of the CEO's job. So that's an example of, the benefit of this systems model. And, we applied it to the go-to-market fit analysis where we sort of connected the board metrics that the board cares about and all these kind of stage metrics, which there are hundreds of, by having this sort of system view in the middle. Then how do you build a systems model? And we go back to the globe and you build it sort of one view at a time. So the way they built the globe was, one journey at a time, and they started adding as they learned these different pieces. So this is obviously a European view of the world for European navigators. And as they explored more, they started adding different parts and having a better view of what the globe looks like. And as a result, a better ability to understand and predict what will happen. So let's now take and start applying sort of different system views to your business. The first system view, which is really important, is to align happy customers with the go-to-market strategy. I know it sounds really simple, but not doing this causes problems. So when you have happy customers, you look at what value they're getting, and that value needs to tie with the urgent pain in the go-to-market strategy. Otherwise, you sell for the urgent pain and they don't get the value, and so they'll churn. In the same way, you want your happy reference customers to be matching your ideal customer profile. Otherwise, you're getting customers who aren't going to be happy. And so aligning happy customers and go-to-market strategy is really important. And what you get out of that is you avoid churn. The other thing is that sales and marketing are usually in charge of the go-to-market strategy. Happy customers is sort of like product and customer success. And so it's a way of making sure the different silos are aligned and working together, which is the CEO's job. So having this alignment is really important. A second system view is to be able to finance growth and negative cash flow. So it starts with having a financial model plan that can forecast growth and cash flow. It also says what the required operating metrics are to achieve the plan. And then you use that to fundraise. Because investors care about the growth rate, the zero cash state, they care about exit and future valuation. So based on their plan, and their belief in the ability to execute the plan, they raise money. And then you have to execute on the plan, which is about spending, growth, tracking these operating metrics. And if you make or beat plan, then you continue this process. Or if you miss plan by not closing a loop, then it's very hard to raise the next round. Another example of the system view is about achieving product leadership. And here you start with the customer journey, which is about making your champion a hero, having the right teaching customers where you become a strategic platform. So that customer journey then drives the product roadmap, which then drives the financial model in terms of how much budget engineering gets, and also forecasting growth from upsells. So as you come up with new product, can you sell the new product, i.e. upsells, and then being able to execute and spend according to plan, build new product on plan, growth targets. And there again, if you repeat the cycle, but not closing the loop creates problems with next round. what I show on the right-hand side, sort of an example of good product roadmap versus sort of bad ones. So as you build up more product features is to the right. And let's say to the far right is when you've completed the roadmap, and the y-axis is ARPU. What you want is, as you continually come out with new products, new features, your ARPU goes up, versus you sort of have to wait until you built everything and then your price goes up. So ideally, you want to sort of keep incrementally getting more revenue along the way. This is about, how to make sure your leaders are in a position to drive growth in the company. I realize I'm running with just a few minutes left, so I'm running faster here. And then this one I was going to do at a workshop, but we don't have time, so I will just quickly drive through. Is that it's about how to build a plan. So you build a plan with your company goals, look at what the department's goals and needs are, and then based on that, you have a plan, which is a summation of what all the departments are saying as it ties into the company goals. What I find with the plan is it's only when you start putting in metrics and bonuses that you get a real idea of what the team believes its plan is makeable or not. And so if it's aligned with all the bonuses, then they're likely to make the plan. If not, then they're going to miss the goals and lose the team, because the plan is really that intersection between the board's desires, which is the company goals, with the team desires to succeed and make their bonus. And so a good plan serves as a bridge between these two particular communities here. And what I tried to do was to just sort of give you sort of different system views. And in each element of the system views is that it's not a functional view. It's not about sales. It's not about marketing. It's a cross-functional activity across different pieces of the business, but it's tied to success in that one slice or that one view. And as you sum it all together is what you get as the system model of the company. So I'm going to just end with just by saying that, wanted to just share with you sort of these two questions, because these are the two main questions that I see founders face, and that is how to unlock growth. And so there you need to find go-to-market fit, and we outline a 4-step path for you for go-to-market fit. And the second is why many CEOs fail is by not having a good systems model of the business. So you're able to understand, explain, and predict what will happen. So want to really appreciate this time to just thank you for listening and asking questions. And if you ever do need to follow up with me, you can just ask me through LinkedIn. And we're also making all this available for free at unlock.survivalthrival.com.
And thank you, Tae Hea, for providing all these resources for free to our startups. I know we have 5 minutes, so let me see if anybody else has any questions. That was a lot of great information for folks to digest. I'm sure there's a lot of thinking going on here. So does anybody want to raise your hand and take this rare opportunity to directly dialogue with Tae Hea? Philip, your question again?
Yeah, thanks. I'm going to do a follow-up. It's really a lot of useful information, so I want to thank you for all this. I'd just say one thing would be, how would you go about testing your playbook once you've established it? What do you use as your key points there?
So the first thing I do to test it is, I just look at whether the conversion metrics, the numbers are sort of consistent with other benchmarks. So that's the first thing is, once you have a playbook and your data model and you have your metrics, it's then easy to sort of understand what's, conventional. It's like the playbook example I showed you was, they had a low conversion rate. Well, how do I know it's low? Well, compared to other companies, it's low. So having a playbook with a data model allows you to do benchmark comparisons to know what stage of the playbook is a problem. And it's not just me. There are others, like we work very closely with Winning by Design, and they're very good at, once you give them a playbook with data models, because they have hundreds of clients, they can sort of say, okay, seems like what you're weak. So that's the first thing, is once you have a playbook, you can figure out what stage, is not working. The second thing is that with the playbook is you can get repeatability. So as you start adding people, you can then have them focus on certain stages of the playbook, and they can repeat it, and that gives you scalability.
Thank you.
I have a question about you said the word benchmarks, and that's one of the things that I think a lot of companies struggle with. And as we move through our evolution and the sales process gets more sophisticated, and we're trying to monitor things like marketing influenced pipeline movement, which is really hard to track, like knowing what content prospects we're interacting with, and then monitoring that, comparing that to how they advance through the funnel, or through the pipeline rather. Do you have benchmarks on that stuff, and do you update them regularly? Because I think best practice is shifting over time, and I think it's shifted a lot in terms of even the granular things like engagement on the website and what types of content companies are engaging with, or whether you should be gating everything, or when to gate, when not to gate, all those details. But even the big ones like contribution to pipeline, should it be 30% always for marketing? Should it be more? Should it be less? What's changing over time? That kind of thing. Are you guys monitoring that, and do you provide that as part of this service?
I mean, we monitor it religiously. It's not on the details are on the website, but it goes back to what I mentioned, that there's just so many metrics that it's easy to get lost in this cacophony of metrics. And you're just sort of listing a few, just as in this, in your question. What I'd like to do is to just sort of step back and build a hierarchy of your metrics. And so start with I think the two most important metrics in your go-to-market are net new ARR for a SaaS company, net new ARR, and magic number. And first see if those numbers are satisfactory against benchmarks. And those are very easy to benchmark, by the way, very easy, because all the public companies comply with that. Then you can go down to then look at the system view. And then the system view allows you to then figure out, what stage of the go-to-market system needs work. I like it doing it that way than to sort of say, it's my web visits the issue, or this is to go sort of top down. But maybe that's because I mostly sit on boards. So, I'm sort of going on a top down view rather than, I'm not the website manager. So, I'm not focused just on the websites. But I like looking at it as a hierarchy of metrics. Because also, if you don't have a hierarchy of metrics, I think these sort of metrics at the bottom of the pyramid are irrelevant unless you understand how it fits into the hierarchy.
Okay. Yeah, I think we know to watch just those metrics. Like in a public company, we don't know how much they're spending really on sales versus lead generation versus sometimes maybe they're published, but I think that may not be the best metric for us to
I mean,
they're more mature.
You can get the magic number. You can get like the magic number, right? Getting below the magic, but you have like magic number. You have net dollar retention is now published quite a bit, and so if you have a very good magic number and very good net retention, then usually and churn, then the math sort of starts coming together.
Yeah, we're tracking that. Okay, thank you.
Great. I know we're at time. Thank you so much, Tae Hea, again, for offering this systems-based model approach. And I think all of us on the call have benefited from this conversation. So I want to extend my my heartfelt gratitude to you. And also startup founders, thank you for your engagement. For more information, I pasted in the link to the book as well as Tae Hea's LinkedIn profile if you want to follow up and dig in more. So that wraps up this workshop session, and have a great rest of your day. Thank you, everybody. We'll resume tomorrow.
Okay.
Thank you, Ricola. Bye.
Thank you. Bye.